Hey traders, Raghee here. Let's kick off this premium video with something that we're going to be dealing with as we wrap up the week, and that is at 6 p.m. today. You're probably going to be watching this video after this has occurred, but at 6 p.m. today Eastern, the guidelines for basically reopening up the country will be announced. So the president's going to be speaking. I guess he's speaking to all the governors now, and then there's going to be a speech. Now, from what we're hearing, early indications are that this is going to be something that will be left to the governors. Now, why does any of this matter? I mean, I'm not interested in politics. Stan Druckenmiller talked some time ago about the importance that he noted in 2016 when many of his contemporaries were getting very wrapped up in politics, and he just traded what he saw, what the price action, what the reaction was in the market, rather than getting wrapped up in politics. And I can't emphasize that enough. This is about seeing a pattern that I'm noticing, probably most emphatically in the way that Germany responded to similar news. Now, every country is going to reopen differently. We have the reopening in Germany leading to not just a gap down, but weakness, not a rally. I mean, that is what one would think. So leading up into the announcement, we see Germany heading higher with global markets, obviously, and then we see the market way down here after the announcement. So that's not to say the market will stay there, but it does seem to be there is a buy the rumor, sell the news type response to these openings. This is China. It looks almost the same, right? Now, China was a little bit different, as I mentioned in the free video, but how is it different? Now, remember, we have shorts in China. We've been open to shorting the FXI, MCHI. We've been open to shorting things like Korea. We've been looking at Singapore. There are shorts to be had in terms of corrections we're seeing in these countries. And so I want to continue to look for those. Germany and Australia are probably two of my favorites because both of them are very economically tied to their largest trading partner, where most of their GDP goes, and that is China. So EWG, open short EWA, these kinds of markets. Again, it's very similar pattern. Now, the reason I bring this up is, let's take a look at the Dow. We're getting, again, a really big rally, a good rally into the close today. In fact, I'm recording this 10 minutes before the close because you can see really clearly, let's go to the intraday time frame, you can see really clearly the rally we're seeing into the close. This is pretty much what we've seen the response in other countries, which is, this is great, we're going to reopen the country, and then, we're hearing different Fed members saying we can't wait until we have a zero infection rate, says Fed Barkin. We can't, we have to move, the economy is under distress from coronavirus, says Fed Williams. I mean, yeah, duh. I don't think we need Fed members to say that. Of course, we're not going to wait for a zero infection rate. That's just not something that's going to happen. But we get these kind of obvious things thrown around. We're finally going to get some sort of game plan. I think along with the narrative of the reopening, where I'm showing you a pretty clear pattern, we're also getting news that the president wants a $2 trillion infrastructure package. So there'll be another 250 billion for now this empty, done, used up loan program, right? The money's gone. They're looking for another $2 trillion in terms of infrastructure. So that is no doubt going to be part of tonight's speech. Again, I think 6 p.m. So if we hear that, I am looking for the market to ultimately, clearly it's good news, right? If you want to look at in terms of the country reopening and some infrastructure spending and what that would mean to the economy, the market's going to look at that. It's clearly good news. But again, what we've been seeing on the tail end of that is a move to the downside. So does the daily time frame actually pan that out? Look at where we are. I'm showing you these great big moves on the intraday time frame. Let's not forget to step back out and see the forest for the trees, as they say, and notice where we are. We are moving sideways. Green candles, blue candles, blue candles. We are moving sideways. This is not a series of higher highs and higher lows. This is a market starting to consolidate, both in terms of the high-low range of the session and also sort of how they're just lined up like dominoes, right, one next to the other. So what is my expectation for movement? Yes, you guys know I'm bearish, but I'm not bearish because I'm just stepping out in front of a bunch of momentum. I'm bearish because the overall trend, well, maybe not the trend, because clearly we've lost the, by the way I measure the trend, we've lost the organization of a downtrend, but we still have a lot of bearishness. Bearishness is more kind of a psychology or a sentiment, and clearly the direction of this market, and relying on the trend that was, as Charles Dow would teach us, tells us that the overall direction of the market has been down. We've corrected, and then if there is going to be a resumption of the trend, probabilities are it would resume in the direction of the trend that preceded this correction or this chop, which is now really looking like consolidation. Now, I'm not looking for lower lows. I'm not one of those people that's going to say we're looking for, brand new lows. I'm not even looking for a retest. Let's talk about what we are looking for. So for that, I'm going to show you something real quick for those of you that have been using the Darvas levels on TradeStation. One of the things that you'll realize on TOS is that there are no sides to the box. Now, aesthetically, I like the box, the way that looks on the chart, but practically the box sides are kind of a pain in the neck. And that is when you are trying to find the wick in order to, do work like we're going to do right now. So you can go into the indicator, and you can remove the box sides. I'm going to type in here false and spell it right. There we go. Type in false, and what will happen is the box sides, voila, will be gone. All right, so I can still see the top and bottom of the box. So what do I want to do now? I want to take a look at what I call the last major move. Last major move. Most recent, significant, rally or decline. And I'm just going to draw a quick Fibonacci to, I'll use the snap mode of the extremes so we can get as close to the high-low as possible. It doesn't have to be to the penny, but that's what we're looking for. What am I thinking we could retrace? Notice I'm not talking about the retracement of this larger move. I think that already happened, by the way. So for those of you that are wondering, Rod, why would you not use the bottom, the lows? Because I think that move already retraced. Here's your high, here's your low. There's your retracement right there. 382, down to the 382, down to nearly the 50%. I'm just looking for that pattern to happen again. Let's make it 382. Let's make nearly a 50% retracement. So for those of you that are wondering, Rod, what is it that you're looking for in terms of downside? This is what I'm looking for. All right, let's take this to something like the EWG, which we do have an open position in. What am I looking at for more downside? Now, now I talked to you guys about these different events, not because we want to get into what they mean and then no, none of that. I want to get into the psychological impact of running a market higher into an event like this, and then what the response is after the move higher. What am I looking for in EWG? Quite frankly, we're about there. I think we might see a little bit lower low, but here between 50% and 618, it's going to make sense to pay ourselves. It's going to make sense to, in this area here, start to think about taking some of the unrealized profits off the table, right? Not that it's the end of the trade, but just in case it is, that we've retraced 382 to somewhere between the golden mean 618, that this might be where the market heads higher, who knows, but we want to be ready for that. All right, so that's what I'm looking for. What about in the example of, for example, the FXA? All right, what am I looking at for the FXA? And I'm going through different alerts that we've had. Okay, so the same process. Now again, notice I'm not taking this move. I'm not doing that. All right, not that that's not valid, but I'm doing this. This move corrected to the 50%. Right? Now what I'm interested in doing is same thing. They're pretty tight. For those of you that are sort of fans of Fibonacci, you'll notice I just moved the exact last major move. There's quite a bit of symmetry here. So you might say, Rod, we hit that 62 level, 61.93, and it's bouncing a bit. That is true. One of the reasons we're bouncing is because anytime we have more stimulus, the U.S. dollar weakens. So, I'm wondering whether or not that level might be ultimately the bounce. I think we should see lower lows in the Australian dollar. But when we hear news of more stimulus, the U.S. dollar does get rocked. It does re-weaken for a little while. I'm still a big fan of long dollar. We still have plenty of time before expiration, but keep in mind, we're going to be likely looking pretty actively at the area between 62 and 61.35 as a place to scale out of FXA. If we make it down to the 786, you can kind of see the shadow of that level down here. That's actually going to sync up pretty well with a gap close down there. It's going to sync up pretty darn well with the gap closing. Okay, so these are the levels. Now, a lot of people ask me, Rob, do you use Fibonacci? Absolutely, I use Fibonacci. It's not the main decision-making tool for me. I do absolutely respect the way in which the Fibonacci tools can measure the expansions and the contractions from the way in which the market moves. Again, remember, Fibonacci is not a trading tool. It's much bigger than that. It's a mathematical law of nature. So what I'm trying to do is find the most recent, in this case, expansion. We call that a trend. And then I'm sort of waiting for the contraction. That would be the retracement. Okay, that's the way I'm looking at that. So that's why that most recent significant sell-off or rally is so important to the way in which I look at these pullbacks and do Fibonacci. All right, so what about the XLE? What about this position here? Last major move, same idea. So we move it over. I'm going to grab our handy dandy tool. Again, this kind of Fibonacci work is not complicated. Now, once you understand this kind of Fibonacci work, you can absolutely start to take it to the next level, and to the next level, and to the next level. I mean, that's clear. I mean, there's so much you can learn about this. But in the beginning, I think this kind of, oh, there's the bell, and boy, is that loud. There we go. See, there's that last major move. We're down at the golden mean. So I've mentioned a few times, hey, if you want to scale out near the value area low and this area that we're at right now, it makes sense to do so. Why? Not only do I have the golden mean 618 support, we also have that value area low for the year also acting as support. And for you fans of symmetry, you'll notice the symmetry isn't quite there, but it's not that far off. See, this move here is just a little bit bigger than the move that preceded it. Just a little bit bigger than the move that preceded it. Pretty interesting, right? It's a very easy way to not only look at the last major move and the retracement, but also is there a quality of symmetry which makes this last major move, I think, even more pertinent. What about XLF? Take a look at the financials, the short via puts that we have. Okay, same thing. Notice the process you use for any tool has to be the same. There has to be a step-by-step, process-driven type of approach. So again, I'm just going to snap it to the extremes. So I'm getting, let's see, nope, I want it to be that one right there, the high, and then if I just ask TradeStation to snap it, I don't know why it keeps missing, but there we go, that's close enough. So notice I'm not getting too caught up to the penny, but the closer the better. So let's see, am I getting that right? Let's try that again. Okay, there we go. So there's your last major move. Here we are, 618. I mentioned earlier today, we're at the value area low. These are, I think we're going to keep going lower, by the way. Financials, energies, I think we're going to keep going lower here. All right, I'm not in any rush to get out of here. I think ultimately we might even close the gap. Again, we might go revisit that gap close. We clearly already closed it here, but these levels kind of hang out there as this little vacuum that then turns into supporting resistance. So to get down to say 20 and a quarter may not be that out of the question. But again, notice value area high 618, last major move, and boom, that one has perfect symmetry. This move has what is symmetry, by the way? Symmetry simply means that the distance from here to here, all right, was the same distance as from here to here. But the length is the same. Pretty impressive, right? So that's a really easy way to do that. Okay, what about looking at the TLT? This is an uptrend. This is the ZB futures contract. So the TLT is where we have the position, but the futures contract is where I want to do our target work here. All right, so what do I think the last major move is, and have we exceeded that last major move, and where do I think we can go? So it's not going to always simply be, oh, we made the retracement. No, that's going to help me with some guidelines, some expectations, right? So let's do this one here. So I'm going to pull that up once more, my drawing tool, and from here to here. All right, that's my move. That's my move. And I want to get to 83, which is where this Darvas level is. As you notice, that would be a 100%. That would be this market going full circle. But in the meanwhile, look at where we are and look at exactly what we hit. Let me show you here. I know it's kind of hard to see. Let me make that 786 a little bit more prominent. It's not one of the more major levels I look at, but it is worth looking at. Okay, this is a really accurate, pretty accurate. I mean, you're noticing how accurate this is. It's not complicated, right? By the way, you're going to notice the two moves that I'm looking for are very often a minor, low, and high. If you don't know what those are, check out Rogge.io. I have a document on what that little 3-candle pattern is. Minor, low, and minor, high. Boom and boom. So where are we? We exceeded the 618. We're heading towards the 786. Pretty much on the money there, right? I think we could scale out at 182. I do believe we're going to hit 183. But if you're looking for those targets, this is how you do it. Okay, this is how we want to focus on. Now, is there symmetry here on this? There actually isn't. There actually is not. You'd have to go back a little bit further to find some. And I don't want to, start to get too deep into complicated fib work. This is keeping it as easy as my mentor taught me many years ago, decades actually. So here we are looking at anywhere from about the 50% to 618. That's a pretty good level. Further out, 786. You notice how we're doing the same process again and again. A lot of folks ask me about that. I think it's a perfect time to sort of show you how I do it as we're looking at some targets. Our book is really definitely moving in our favor. You saw all we needed was just that one down day, the last session before last, and our book, kind of righted the ship just like that. One or two more down days, perhaps, as we talked about at the onset of this video and I touched on in the free video, buy the rumor, sell the news on the reopenings of the country. We've seen it a few times now. I've shown you the pattern. They're darn near identical. I'm not looking for a huge move lower, but just another push in favor of our mostly short book in terms of risk. We're risk averse really right now. So hope this helped. Hope this is something that can give you some framework and predictability and a process around this. It's a very simple way to do it. I've been doing it this way for darn near 3 decades. In fact, my work on Fibonacci preceded even my wave and my grab candles. In fact, the grab candles are created because of my adherence to Fibonacci numbers. 34, of course, is a Fibonacci number. Our propulsion dots, by the way, those are also predicated on Fibonacci numbers, the Fibonacci number series, okay? So hope that helps. I'll see you in the next update.